In today's episode of the MSA Rental Market Update, we are looking at the San Antonio rental market for conventional multifamily properties. As you can see, we have the San Antonio metro statistical area drawn out by CoStar, as you can see here on the map. And this will give you a good representation of where it is in the state of Texas. So we can see Austin just to the north of it. If we continue up I-35, we get up into the Dallas-Fort Worth metro area. If we come across I-20, we come into Shreveport, Louisiana, come down 49 to Lafayette, Louisiana, back west on I-10 to Houston, Texas. And of course, if we continue down 10, we can end up all the way into El Paso, which is outside of this view. So let's take a look at the filters and see what we are excluding. And as usual, we are excluding corporate, military, senior, and vacation, and we are only including market and market affordable. Now, before I get going too quickly here, let me say that we skipped a day. In the 8th week, we finally missed a day, where yesterday I was supposed to do the San Antonio metro statistical area, but I had some issues with CoStar and I was not able to get on. Those problems have since been resolved and we are back in business. So that said, there will only be 4 MSAs this week. Today is Wednesday, the 8th of March. So we will only do 4 this week instead of 5. All right, so let's go take a look at the analytics and see what the San Antonio MSA for all 3 asset classes combined are telling us for the rental market update. So here is our supply side snapshot. You can see there are 1,878 properties in the market, totaling 211,522 units. There are still 16,991 properties under construction, which is unfortunate considering that 1,004 more properties went vacant than rented in the San Antonio market over the last 12 months versus 9,053 properties were rented over what went vacant the previous 12 months. So that is probably one of the worst 12-month absorptions we've seen yet over the last 8 weeks. We'll see what this looks like in the demand analysis as we go into the data, but right now not looking very good for San Antonio. We can definitely see this. We had a 6.4% vacancy rate a year ago, and now it's sitting at 9.6%. We are showing a very slight year-over-year rent growth, but we'll see what it looks like quarter over quarter. As usual, we are not looking at the capital markets. We are only looking at the space markets. So as I scroll down, we can see that the long-term occupancy average for this market is 91.25%, or about 91.25%, and it is currently sitting at about 90.5% or 90.45%. So we are below that long-term occupancy average, and that shouldn't surprise anybody considering the fact that over 1,000 more people have moved out of the market than have moved in the market over the last 12 months. So when we get to the end of this video, I will plot where this market is on the market cycle chart, but I can tell you right now it is not looking good for the home team. So let's go take a look at the data and see what the data is telling us for all 3 asset classes combined. So here is our rent analytic data. We do not look at asking rents. We don't care what the ownership is asking. We only care what they are collecting. So we are looking at effective rent. First quarter 2022, it was $1,221 a month, went up to $1,252, and like most markets, it broke between the second and third quarter, and the downtrend started to $1,243, then to $1,225, and it looks like we got a little bit of an uptick in the month of January. Let's see if our demand says that we should have gotten that uptick. We've seen in a lot of markets here lately that we're seeing this uptick in January, even though we have continued the occupancy trend in the wrong direction, which means we should not have seen that uptick. So let's see what this market is telling us. If we look at our deliveries, we have 903 units delivered in the first quarter, and another 29 units went vacant. Then 839 more units went vacant. Then 320 more units went vacant. And you guys can see that this is not telling a very good story at all. And if we look, we can see we've gone from 93.9% in the fourth quarter of 21 to 90.6% in vacancy or in occupancy in the fourth quarter of 22. That downtrend continued, even though we saw that little uptick in rents. We did lose 0.2% occupancy because 604 units delivered and only 147 of those absorbed. At least there's some positive absorption in the first quarter, only showing the first month right now. We'll see if it can sustain positive or if this will turn negative as more units deliver, and we'll see if they can absorb or not. This potentially can go negative once we get the full quarter numbers out. As with the other markets, this is a factor of a couple of things. Either the ownership raised rents arbitrarily because there was a feel-good in January. Everybody thought that we had captured inflation, and there was talks about interest rates going back down, and there was only a quarter-point raise in interest rates. So all that led to potential raise in those rents, even though demand said we don't have the demand to raise the rents. So let's go take a look at Class A's and see what they are telling us. So here is our Class A rent analytic data. There are 235 properties totaling 63,364 units. Looking at the effective rent, first quarter we started at $1,477, went up to $1,518, and as expected, second to third quarter we had that drop to $1,491, drop to $1,458, and then a slight uptick in the month of January. If we scroll over and look at deliveries and absorption, we had 541 deliver and a positive absorption, albeit nowhere near the 541. So it looks like the Class Bs may be part of our problem here for absorption. We'll see when we get over to the Class Bs. Could be a combination of Bs and Cs. But we did have negative absorption in the second quarter. We did not have any deliveries. So out of the 224, a little over half ended up leaving the rental market, bringing that even worse. So you can see our occupancy is definitely ticking down. Then 634 deliver, only 141 absorb, ticking our occupancy down even further. Then another 738 deliver, another 161 go vacant, taking our occupancy even further down. And we even went down another 0.1% because we delivered 216 and only absorbed 85, yet we still had that uptick in rents. So interesting tale there. So it looks like demand supply fundamentals in the year of 2022, first quarter through fourth quarter, is reacting appropriately, and the first month of January it has not. Now, me personally, I believe that there's not enough data yet to be including this Q1 quarter to date information, but CoStar has said these January numbers are complete. But from what we're seeing, it isn't quite making sense. So I don't know whether to believe that or not. I'll leave that up to you guys. All right, let's go take a look and see what the Class B story is telling us. So here is our Class B rent analytic data. There are 520 properties totaling 77,428 units. Looking at effective rent, in the first quarter of 2022, it was at $1,234, went up to $1,262, then down to $1,259, so that break between second and third quarter, then down to $1,236, and then very slightly up to $1,240, so not as big of a jump in the rent in the first month, but still a slight bump. Let's see if deliveries and absorption tell the same story. So 350 delivered, and another 25 went vacant. Then 695 more delivered vacant, and 191 of those absorbed. Another 379 went vacant, and another 97 went vacant on top of that. Another 2,500, almost 2,500 went vacant, and only 422 absorbed from that. Then another 385 and 253. So strongest showing we've seen yet for absorption in the first month of the year in the Class B rents. So not too terribly ashamed of the $10 bump. But again, we did get a downtick in occupancy. So occupancy's gone from 92.7 in fourth quarter of 2021 all the way down to 88.6%. So even below 90%. So the Class B rents are not doing good. There's definitely a sign of weakness. We'll see if the Class Bs can hold up with this absorption getting through the rest of the quarter. Time will tell. Way too early to determine that right now. But it does look like demand-supply fundamentals are at least working in the Class B space. Let's see what the Class C market is telling us. And from what I'm seeing, my guess is we're going to see a whole lot of red in this absorption category. So let's go take a look and see if I'm right. So here's our Class C rent analytic data. There are 922 properties totaling 70,395 units. Looking at effective rent, first quarter of 2022, we started at 951, went up to 972, up to 976, up to 979, and then up to 987. So an uptrend all the way, and we've seen this in a few markets. I'm going to venture a guess, and I'm not looking at the vacancy, which is in our view, but I'm going to guess that we're going to see a whole lot of red in that absorption column. And as I scan over and look at vacancy, I can see that vacancy has steadily increased this entire time, albeit not too terribly bad. It is around that long-term occupancy average. Actually, that long-term occupancy average, I think it was 91 something. So not quite or hitting right on that long-term occupancy average. So, can we condemn the owners for increasing these rents when the vacancy was still pretty low in the Class C market? I think the answer there is no, we really can't. But as we are now sitting on that long-term occupancy average, it looks like that this point moving forward, we're going to start to see those rents go down in Class C. And as expected, there's all those red numbers that I expected to see. So 226 went vacant in the first quarter, another 385, another 680, another 447, and another 189, even though we saw rent increases in every single month. What this is telling us is that demand is definitely left the building. Okay, there is virtually no demand for rents or for apartments in this market because we've had, what is this? You're sitting about 600, 1280, 16, let's call it 1700, let's call it 1800 units went vacant in the last 4.25 quarters or 4.33 quarters. That is not good. These renters have said, we've had enough. Sorry, we're not renting at these prices anymore. We're going to start roommating up, or what's known as doubling, which really affects that demand. So I believe that's what we're seeing here. So the Class C market, as far as rents are concerned, we're holding strong. But as far as demand has definitely waned and is tanking for the Class C market. Waffled a little bit in the Class A and Class B, but we still saw those downtrends in the third and fourth quarter for both those asset classes. So let's take a look at the market cycle chart and see where we would place this. Remember, we were about 0.75 of a point below that long-term occupancy average. Demand is definitely waning. We are seeing the vacancies decline in the A and B. I'm not going to count that first month, not until I get a full quarter of data on that for right now, because it just isn't making sense. And the Class Cs are the only ones that have maintained their rents, but they are now sitting on that long-term occupancy average. So my guess is that they're going to start going down moving forward. So I would place it either on the very bottom side of the long-term occupancy average or right at this point. I really don't feel like we're quite down here yet, but I also feel we're a little lower than this. So if I had a point in between these two, I'd kind of place it right in between. So you be the judge whether you want to place it on the bottom side of the long-term occupancy average or at this point right here in the recession. But I think it's clear that the San Antonio metro statistical area for conventional apartments has definitely entered the recession phase, albeit just now entering that recession phase. So that does it for the San Antonio metro statistical area rental market update. Stay tuned tomorrow as we will take a look at Columbia, South Carolina, and then we'll finish the week with the Northwest Arkansas market and see how Walmart is performing. I will see you guys tomorrow.